and welcome back to The Financial Operator. I am Jen Pfizer, your host, and I am here today with Andrew Ackerman, and he has a really interesting story. So we are going to start first with the question that everybody wants to know. Andrew, tell us about the time you ran out of money.
I have 3 teenage girls, so I find my wallet empty a lot, but I'm guessing you mean in my first startup.
Yes, you can tell us. I'm sure many of us have experience with these teenagers.
Yeah. So before I had 3 teenage daughters, I had my first startup. It was a company called Bunk One, and it was, basically internet services. We would call it SaaS for summer camps. So, we rolled it out. 2 of my friends and I rolled this out, and we had our first year, and it was kind of really good, we thought, for a startup. We had a term sheet on the table from a VC fund, and we were excited about that. But since it's summer camps, it's a seasonal business. So we're like, let's wait until the end of the summer. We'll see what the revenue comes in, and we'll negotiate for a higher valuation. So everything's going great until some terrorists ram planes into the World Trade Center, which happens to be where our VC was headquartered. So on September 11th, our term sheet literally went up in smoke. Fortunately, the people we were talking with were okay. But the fund was gone, literally gone. So, we were kind of out of luck there. We ended up going.
Was that your first year in business too?
Yeah, it was. We had founded the company. Like, the founders had been going around with like a CD-ROM demo in 1999. I was the 3rd founder. I joined after the CD-ROM. But yeah, it was probably the first summer was nothing. We were still building. So this was after the first summer of operations. Okay.
Wow. So one year in, you had an offer on the table, which is impressive, even that quickly too. So what happened next?
We went without salary for a year. It was pleasant. I've come to be a big believer in like the Game of Thrones approach to fundraising. Like, winter is coming. Don't over optimize. Like, if you're a tech startup, or even if you're not a tech startup, you're a traditional small business. You have an offer on the table to get financing. Like, there's a certain virtue into just taking the money and not worrying too much about the exact amount. When you're further along and you have a lot more, room for error, like margin for error, then you can start optimizing. But early on, just take the money. You never know when it's going to disappear.
Yeah. I actually went through that with a client not too long ago. And oddly enough, they were like first year in business too. And they got an offer from private equity, and they didn't take it because they were like, oh, I think we could get better down the road. Well, so then 6 months later, they were like cash strapped. And so it's like, okay, now we're just taking whatever offer we can get. And so, yeah, sometimes it's better to just take what you can get up front and then, figure out where the chips lie after that.
I mean, now that I'm on the investor side of the table, I've been on like 7 sides of this table. It's kind of a weirdly shaped table in my world. And I advise a lot of startups on their fundraising process. I always tell them, like, you're either in fundraising mode or you're not. And the difference between the two is, it's like 80% of your time is going to fundraising. The rest of the team has to work on their own, or like 10 to 20% of your time is kind of passively creating these relationships. But if you really want to optimize it, it can't be a marathon. It can't be, we'll see. Like, when you are actively fundraising, you have to be actively fundraising, because you have zero leverage unless you have multiple people interested at the same time. And if you only have one person interested, then you got no leverage. And then it disappears, and what happens, that's history.
Can we talk about what businesses are ideal? You are on the venture capital kind of side of things. What businesses are ideal for that sort of model?
Yeah, so that's actually a great point, right? So we have this whole world of startups out there, and it could be anything from like, I've started my own law firm, or I bought a car wash, or whatever it might be. And then there's this tiny corner which are tech startups, and that gets all the press and all the glory. But it's really kind of a crappy corner to be in, right? If you're a consultant, or if you're an accounting firm or a lawyer, you can fund yourself out of revenue, right? You go out there, you get a couple of clients. You never have to give away part of your business. You never have to take a loan. I'm not saying it's not risky and all that, but you have those options. If you're a car wash or a restaurant, you can get a loan from the bank. They understand your business. You have assets they can take. Might not be great, might not be great interest rates. You might have to give a personal guarantee, but you can get a loan. Now, those tech startups in that kind of weird little corner, no one's done it before. Otherwise, why bother, right? Mm-hmm. No assets. It's usually just software. Or if it is a little bit of hardware, it's hardware that's absolutely useless to anyone else, right? They can't even get hard money loans. So the only thing they can do is get money from a VC or friends and family. So it's kind of a different world there. Now, what's common about it is the question of what are your alternatives? So if you are in a traditional business, the choice might be between taking money and growing faster or not taking money and growing organically. Mm-hmm. And if that's the case, that's a decision you have to make, right? It's really up to you. Do you want someone else to be looking over your shoulders? Do you want to make the money faster? That calculus isn't always available to a tech startup because tech startups are doing things that are brand new to the world. And in a couple of years, they're not brand new to the world. Mm-hmm. If I can't find the why now that's implicit in a startup's pitch, why couldn't this have been done 3-4 years ago? Then odds are there are hundreds of other hungry entrepreneurs that have tried it, maybe very far ahead, or maybe they've all failed because there's a flaw in the basic idea. The market just doesn't want it or what have you. Mm-hmm. So you don't have that luxury as a tech founder. If any of your peers take venture money, and some will, then they're going to get ahead of you in the market. And in many cases, it's a winner-take-all business. Mm-hmm. So if you're a traditional small business, you can kind of make that decision for yourself if you have the luxury of going slow or raising money. If you're a tech startup, it's almost always you got to take them.
Okay. What does that mean for the company when they take money? Are they giving up equity? Are they giving up just it can be anything, I assume.
Great. We are, I don't know, let's just say 5 minutes in, 7 minutes in, and you've come to the great VC, it depends. Yeah. We use that phrase a lot. In this case, it depends on what offer they got, right? So in the traditional world, you might get a loan from the bank. You might take on a partner. Similar ideas in the tech world, only we call them different things, right? So you might get a convertible note, right? So that's basically a loan, but the idea is it will turn into equity later when you raise your next round. So, okay, that's debt. The other opportunities you might take, you might just take equity, right? Hey, I'm going to buy 10% of your company. Here's a check. And then there are things kind of in between, which we call SAFEs. It stands for a simple agreement for future equity. It's I'm giving you the money now. You don't give me any shares yet, but we have this contract that says, when you raise your next round, you'll give me a certain amount of equity based on these horribly complicated formula. That's usually what it is when you start out. And when you get a little bit further along, you get the luxury of maybe some other options. You might be able to get a traditional loan from the bank. You might be able to factor your receivables or do some kind of asset or receivable-based financing. But at the earliest stage, it's usually convertible note, a safe, or actual, we call it a priced round, but, actually selling shares in your company.
Okay. How early on in the startup of the business should they be looking for funding?
So that's a great question because where that has shifted dramatically over the course of my career. But the general principle is actually the same. So the general principle, and I say this should apply to everybody, is you don't ask for money until you've done absolutely everything within your power to push the business as far forward as you can. And that could mean, you've launched a prototype of the product and you're getting beta users, or, you've launched kind of a, pay no attention to all the stuff I'm doing manually behind the scenes, but you can start paying me now, or using it, or getting feedback, or even going through your model and saying, well, here are all my assumptions. How do I prove as many of these as possible before I go out and start building and testing? Mm-hmm. Now, back in the early 90s, which was even before my time, it took $5 million to get out of the door, right? Because you need to buy your own server. You often needed to then put it in your office in a temperature controlled case. And that was it. That's how you hosted a web page. Mm-hmm. Really, really early. When my startup, and that had to be $5 million, you couldn't do anything, right? I mean, you had to code everything from scratch. It was hard. So in that case, you could go to a VC with a business plan and say, this is what we want to do, but we can't do any of that without some money. Now, a couple of years later already, you had other options, right? So there were hosting services, or you could actually physically host your server. Like we had a place called Globix. It was in the World Trade Center area. And it was kind of underground, temperature controlled, rows upon rows and rows of racks. And we'd come there with our blade server. We'd slide it into the rack and we'd connect the cables. And I remember when we got our third blade server, the CTO turns to me and was like, I should really have labeled the cables. Like, I don't know what I can unplug without taking the site down. But you still had to physically do it, but at least you didn't have to have it in your office and worry about the data connections. So that got better. And then a few years later, Amazon Web Service comes out and you're like, F that, I don't need my own hardware. I'm just going to use fractional servers from AWS. It'll just happen behind the scenes. So it got cheaper and easier. And along the way, we had more APIs. Like people were building other mini services you could just plug into. GitHub came along and you could start, pulling code that other people had written and you could adapt it. Now we have vibe coding where, whether you're a programmer or total novice, you can even do a lot of this. It's relatively simple. You can do this just asking AI to do it. So along that period, the cost of getting out the door of the startup went dramatically down from like 5 million to 500,000 to 50,000 to like $5,000 to nothing in some cases. Now, the right hand giveth, the left hand take it away. Oh, I'm dyslexic, sorry. The right hand giveth, the left hand take it away. All this is awesome. But what it means is also from like the cynical guys on my side of the table are like, hey, Jen, you can do so much more without my money. How far along are you? So where you could have come in and said, hey, I need the money to get started. Now I'm saying, Jen, I don't see why you
do a
can't
lot
get
of
the
that work
revenue before you're asking me for money. So the bar gets raised.
Tell me how you got into this, because obviously you didn't just start day one with a business. So.
Yeah, I'm not sure I would make a good guest in anyone's like career counseling presentation. So I graduated business school in, don't tell anyone, 1995. And back then, from where I came out, it's like the door on the left was for investment bankers. I got my left correct this time. The door on the right was for management consulting. I was in Chicago boots. So if you're into marketing, like you were in the wrong place. And like this whole startup thing meant, you're an entrepreneur. Oh, you're unemployed. What did you go to business school for? It just didn't exist. Right. I still remember it was, I guess it was 1994. And I remember seeing Netscape Navigator, one of the first browsers, and thinking, that's really cool. If there's ever anything on this web thing other than government data sources, it's going to be huge. But of course, there wasn't. And this whole culture of like startups and that hustle just didn't exist back then. So I spent 4 years as a management consultant working with big, boring Fortune 100 companies, oil and gas, automotive, pharmaceuticals. Good people to work with, really smart people, challenging. My daughter's actually looking for an internship in consulting right now. So if any of your listeners are looking to hire a very smart University of Michigan sophomore, like I have a lead for you, but not where I wanted to be, long term. And then I was on a project in 1999 where we actually built this intranet application for two companies that were going to merge. So we could merge all their financials without either party seeing the other data, so that if the merger didn't go through, there was no antitrust issues. People weren't contaminated because they'd seen the other, deck of cards. And I remember thinking, now it's here. This is what I wanted to do. I always wanted to do this. It just didn't exist 4 years ago. So after a very brief stint in Kaplan Test Prep building products, for their internet strategy, I ended up with my first startup, Bunk One, which we talked about. I did that for 8 years, got exited. It's kind of a longer story.
Worked at a family office. Got paid in that first.
Oh yeah. No, I did have an exit. There was cash given to me. A little complicated. Maybe we'll get to it. But then I worked at a family office for a couple of years. So, for those of you who don't know, that's a rich old guy in my case, or a family founded by a rich old guy who needed other people to manage their money and maybe make donations to charity on their behalf. Not my guy. That wasn't his thing. And then after 3 years, I did another startup, which if experience is what you get when you didn't get what you wanted, was an awesome experience. And then ultimately, I found my way into a VC/accelerator called Dream Adventures. I did that for a bunch of years. And now I do 6 or 7 things. So for anyone planning their career, that's not the way to do it. right?
It sounds like mine, very different paths, obviously, but I'm like, this was in no way set up to get me to where I'm at, but it also kind of all fell into place to get me to where I'm at. That's just how it works out, right?
I feel that way also. Like these kind of like either non-traditional or zigzagging paths mean in some ways, you're not as deep experience-wise as people who took a more linear path. But on the other hand, in certain rarefied circumstances, you are now the only person who's right for that position. Mm-hmm. So it's a little bit more of a high-risk strategy, if you want to call it a strategy. I don't know that it was a strategy.
I'm a well-rounded business owner because I learned all of these other things in different roles that are not at all related to finance, but, get you where you want to be. So, okay. So let's go back to the early days and maybe not the early days, the mid days here. Okay. And because you worked with a VC company, right? Did I understand that correctly? And you were kind of on the other side. You were the one giving money to startups? Let
me give a little background for, I don't want to make any assumptions, right? So VC fund's a venture capital fund, right? They're one step after angel investors. They invest pretty early in startups. Angel investors are like, oh, it's a Wild West, right? You got an idea, cocktail napkin. Usually not, but that's the general idea. Yeah. So in between the two, or kind of overlapping with them both, are things called accelerators. Sometimes they're called incubators, sometimes they're called studios. They're not standard terms. But the idea is we go out there and we find entrepreneurs in startups that are not quite ready to raise just yet. Now, each program has their own kind of criteria, but for us, we were looking for startups that had their product done or almost completely done. Single quotes around done. This is never really done. But they had good enough to roll out a minimum viable product or an MVP. And we would work with them to refine that, to teach them how and to help them raise money, to help get them introductions to customers or channel partners. So we were getting in when the product was, the company was 3/4 baked or 2/3 baked, help them get to that next point and then help them raise a seed round from an actual VC or from a group of angels. So that's where I came in. And the beauty of it for me was I'm still very close in some ways to being the founder. I got much more involved in the startup than I would be if I were just a VC investor. I'm meeting with them, once or multiple times a week for like a solid 3-month period under that model. But then I'm also dealing with 10 or 12 companies at a time rather than just the one. And as part of that process, there was a financial investment made. So that's a kind of typical accelerator model. We had our own VC fund that was connected to it that made those investments. We changed over the years. There are other accelerators that have different models. So like, kind of seen one accelerator, you've seen one accelerator, then you have to ask. They're all a little bit different. But that's the transition I made from a founder who had one startup to an angel investor who was, to be brutally honest, totally clueless and investing in a handful of startups and just getting a little lucky to actually starting to invest kind of at scale. Okay.
So in those accelerator programs, are those essentially like the minor, like you're creating your own, like homegrown, I'm not using the right language here, but like you're kind of growing them to where you want them to be, so then you can invest in them to a higher degree?
I don't know if like the farm team major leagues analogy is totally perfect, but a little bit more think of it like basic training or boot camp. Okay. Right? Like when you as a potential soldier go into basic training, like nothing. And at the end of those 4 or 6 months, you're finally like competent enough to know which end of the rifle goes forward. And then you can start, specializing or, learning stuff for your particular unit. Again, like analogies are all imperfect. In our case, it was kind of like the last couple of months of basic training. Right? Okay. There were other accelerators that would take people like, hey, you got an idea? Come on in. We'll run you through the whole process. But for us, that's, the earlier you get, there's a lot more like flakiness and like a lot more, even with dedicated founders, it just doesn't work out. Same for a traditional startup. The earlier you are in the process, the higher the failure rate is. So our sweet spot were, 2/3 or 3/4 baked, just that last leg. But yeah, your mileage may vary. Different accelerators work different ways.
What characteristics do you see out of the people that do succeed in just in general, I guess? What characteristics do those people tend to have?
Sure. So, and I like the way you asked it, right? Because when people ask, like, why do startups fail? There's a zillion reasons they fail. Mm-hmm. Like, they fail because they didn't do everything they needed to do right to survive. But there's certain unifying characteristics where, if I don't see them, it's like a hard pass. It doesn't matter what you're building. It's not going to work. Somebody else will make that work. So in no particular order, one of them is the phrase I like to use, founders who have well-reasoned but loosely held opinions. And again, I would say this across all, I'd say even not in startups, even for success in life. Like everything that you're thinking about doing or you think, I'm going to do it this way, you should have a well-reasoned plan for why you feel that way. Let's not, I read up, that's how a lot of people are doing it, or I ran the numbers, blah, blah, blah. But they should be loosely held. So when somebody comes to you and says, so listen, Jen, I know you're planning on doing it based on all of, like this track record of other people, but like the world has changed and like these 2 or 3 things are very different. I don't think what worked yesterday is going to work today. Mm-hmm. So as a founder, you might look at it and say, what, that's very reasonable. I got to think about that again. But at the same time, you don't want them to be a weather vane. You don't want like, hey, Jen, I think you should try this instead. Like, okay, I'm going to go do that, right? You got to have like that well-reasoned basis for you. Because otherwise you get people who are stuck and will not change course despite the evidence. That's a fail. And people who are changing course every 5 minutes based on the last person they spoke to, which is also a fail. Okay. So that's number one. The other one, again, no particular order, is empathy. Now, what I mean by that is something very specific. Sympathy is, oh my God, that must have hurt. Empathy is like, oh my God, that happened to me. I know exactly how much that hurts. And the difference is one of them you can kind of see from the outside, and the other you're interiorizing what the other person feels and what they're going through. Now, the ability to do that and put yourself in your customer's shoes is invaluable. Mm-hmm. Right? You can't really sell to someone unless you understand what motivates them. Right? If they're in a business world, what gets them promoted, what gets them bonused, right? What gets them fired, what gets them like recognized. In the private world, like where are their pain points? Where are they time starved? Where are they looking for solutions? To be able to put yourself on that side of the table just makes you so much better as a founder. And I've talked about customers. That applies to everybody. Same thing happens when you go to raise money. Right? When you're going to raise money, understand what motivates the investor. Heck, when you're hiring people, understand what the people who are sitting on the other side of the table thinking about maybe they want to join your firm are thinking. So just across the board, it's a useful skill to have or to build. Right? Mm-hmm. And both of what I just mentioned, they're both learnable. Some people come to it more naturally or more intuitively, but they're both skills that you can acquire and you should acquire if you want to be a successful entrepreneur. Mm-hmm.
I think that's great too, because both of those things that you mentioned are not always the things that are kind of pushed in the entrepreneur world. So a lot of times with your first point, it's like, it is pushed on you that you should, at least in the circles that I'm seeing, a lot of that, like whatever it is, like you need to stick to whatever you're doing 100%. You have to keep going with no going off track in any way, right? Like you need to have your road paved and you stay on that road. And I think to your point, there's maybe a lot of ways to get to the end goal, and the way that you pick on day one is maybe not the best way to get there every time.
Yeah. The technical term for that is Hollywood bullshit. Pardon my language.
Yeah, no, exactly.
We all see like, it's like, the movies about, Facebook and like, it's not like that. The Steve Jobs biopic, it's not like that. It's not like glamorous.
Yes.
It's a lot of hard work. And on the flip side, a lot of the books out there are kind of boring how-to guides. And I think they're all ghostwritten by the same guy in like Indiana with the same chipper tone and it's the same format, right? Anecdote, name drop, name drop, name drop. half-page summary at the end of the chapter and bullet points. And by
And
the way,
after
if
you
you
read
rip
the
out
first
those half-page
three,
summaries and staple them together, you got a great 25-page PowerPoint. But they're like definitely boring to write, but more importantly, but more importantly, they don't give someone from the outside a realistic feeling for what does it actually feel like to build a startup? Is this something that's right for me? Should I leave my day job right now and solve that problem that I think I have an awesome solution for? Or is this like not something I should do? Right? That's why I wrote my book the way I did. I wrote it like a story, like a novel. So you can actually feel the journey of this fictional startup. And in addition to like everything you need to know to get there, actually understand kind of what goes through the founder's mind and whether or not starting a business, any kind of business, is something that's right for you at this point in your life.
Speaking of your book, can you give us a quick book plug here?
Oh, I would never want to do something like that. So commercial.
I'm begging you.
I mean,
please,
it's totally by chance that I have the copy, right? Like, thank you for asking. Sorry, I almost forgot to plug it earlier on. So listen, I told you this, I've been doing this for 20 years, like 70 plus investments over the years, worked very closely with hundreds of startups. I've seen literally 10,000 plus startups. I can show you the math if you don't believe me. And the things along the way I learned was that like these lessons that we talk about, they work better in the form of a story. It's more memorable. You can identify with them. It's not by chance that, not that I'm comparing myself to this, but like every religious text is the story of colorful founders. Never, it's like, okay, Jen, here's what you can't do. Right? So they always embed moral lessons or lessons of any kind in a story, and it sticks better. So when I wrote The Entrepreneur's Odyssey, I was sort of thinking about writing it. I knew I didn't want to be one of those boring how-to guides. I'm not from the Midwest. I don't talk that way. I can't even read those books. My eyes glaze over, even when the content is good. So I knew I wanted to write it in the form of a story. I've written 60, 70 articles already. I kind of enjoy it. No AI was used or harmed in the making of this book. So it actually doesn't read like a semi-autistic 15-year-old boy. But I wrote it about this fictional startup from the idea, pitching the idea in an evening startup event to a bunch of angel investors, all the way through the process until he raises his first round of financing.
All right. So it is a fictional nonfiction type of book.
So I found out it's a little bit of a funny story, right? So there is actually a book that I read in business school called The Goal, which is a novel disguised as a textbook. So here I am like talking to a bunch of potential publishers. It's like kissing frogs. I thought I'd have to talk to 200-300, but I got very lucky. On like my 20 or 21st conversation, I'm talking to Routledge Press, who ultimately published my book. And like, oh, we love business fables. I didn't know it was called that. We love business fables. We published The Goal. And like behind the scenes, like I'd actually based the format on that book. But nobody knows that book anymore. It's been a while. So I describe it as Lean Startup meets The Alchemist.
Okay. I like it. All right. So in what kind of business? It's a tech startup that's in the business?
Yeah. So my world has been tech startups. There's a lot of carryover. Of course, there's some things that are very like unique to it. But, let's talk about like one idea that I put in the book that I talked to a lot of my startups about, and it works equally well in a traditional small business versus in the real world. And it's all about testing something before you devote time and money to doing it. So I'll give you two versions of it. The first version is in the book. I call it the index card app. So if you're thinking about building a website or an app for your traditional business or that is your business, before you code anything, buy yourself a pack of index cards. And then like steal a pen from your local bank, because we're scrappy startups. We don't want to pay for things we don't have to. And sketch out on every screen, on every index card, the screen of your app or website. And you make it like childishly simple drawing. You don't get people hooked up on the artwork. And then you go to 20 or 30 of your customers and then say to them, hey, Jen, listen, I want to talk to you about what I'm thinking about building. I want your honest feedback, right? If it doesn't work, like you'll be saving me 3 years of my life. So please be brutally honest. You have to give people permission to tell you your baby's ugly or they won't. But here's what I want you to do. I've sketched out my app here. I'm going to give you this. I want you to pretend that's your phone, right? You look at it. If you want to click a button, tap it, swipe, whatever you would do if it's your own phone. I'll give you another card, another screen based on what you're doing. Don't ask me any questions. I'm not there if you downloaded the app. Can't answer them. But do kind of verbalize what you're thinking because I can't read your mind. Right? And then you go through the site that when you do that for 20 or 30 people, a couple of things will become blatantly obvious. Number one, whether it's an important problem for them to have solved. Okay, well, that's a problem for you, right? That means they're not so jazzed about it. Or they might be really into parts of it, but they never go into like some other section of your app that you thought was important or some other section of your website that you thought would be important for, selling your service. So then when you break character at the end, you're like, hey, John, I noticed you didn't do any of that. Why not? And it might have been a user, UX, user experience or UI, user interface issue. Or it might just be that whole feature doesn't matter to them. And guess what? If you do it this way before you program, you've now saved yourself a bunch of months and cost because you're just not building stuff that people don't need. And along the way, you'll figure out like that's confusing or they're worried about something here, which that's why they hesitated. I have to give them reassurance at this page and so on. But for the cost of like, $6, $7 for a pack of index cards and the pen, remember to seal it from your local bank, you can save yourself tons of time and money. And if you're on the business to business side, this part's not in the book because this is a different type of startup. This is a true story from my Accelerator days. There was a company that was helping large, other large companies in the media space allocate money between social media platforms, Facebook, Twitter back in the day. And they were doing it like in their day jobs. They had done that manually with spreadsheets, copying and pasting numbers. And like, there's got to be a better way, which is how most startups get started. So they quit their day job. They came into our program. And they knew that they could program all this, but they didn't do any of that. They hired a bunch of interns and they did it all manually. But behind the scenes, that was all behind the scenes. But as far as the customers that they went to and they sold the product to, it looked like it was all automated. Every Sunday, they got a report that said, here's your performance, your past spend, here's our recommendations, click yes to accept. And they did it. And then the interns would go do it behind the scenes. So when they got up, first of all, so they built nothing. Interns are relatively cheap. And when they got up to demo day, the presentation at the end of the program, and the investors were like, yeah, how do you know customers would want your service? They're like, we're already charging them for the service. They're already paying us. Oh, then what are you raising money for? We just need to automate it. And that's an awesome position to be in because you've proven the most important thing, that you have a business, that you have customers, that your pricing is good enough. And then the other stuff like, what, is this hard to build? Doesn't look hard to build. Great. That's an easy investment for someone like me to make. But again, the theme is, what can you do first, cheaply or for free, that helps you determine like what you actually need before you go out there and build it, before you buy that piece of equipment that you think, your customers need because, they want that kind of customization to the product you're building for them. Nobody wants it. Don't buy that equipment. Right? Don't program that part of the website.
This is kind of not in the tech startup world, but like on the just regular running a side business or something, like making sure that side business can actually has legs, has some so you can get customers before you go and quit your W-2 job that's paying your bills. Like make sure that you can have a product and maybe even that you like that product or like whatever you're doing.
Yeah. I mean, let's take like a silly example. Like you're a restaurant, right? You have this idea that like your customers are going to want like a certain type of food, but it requires like, a set of deep fryers. I don't know. Pick something that's really like actually big, bulky and expensive in a restaurant. So you can go out and buy them and then find out no one wants it. Or you can find some way to kludge it together and do it manually, put it on the menu. And if a lot of people buy it, you have a good problem. You're like, okay, great. That was a lot of pain and suffering to do it the old way, but I know people want it. Now I'm actually going to go invest in the equipment.
Yeah, that's a I have a friend that she wants her husband to start a like contracting business, and she's like, he needs to go out and buy all this equipment. I'm like, maybe he just needs to start like seeing if he can get some jobs first before we spend $100,000 on some equipment.
Yeah. And then, rent, beg, or borrow what you need to start with.
Exactly.
Right? I'm a big fan of like trading, and it's okay if you pay a little bit more for it, right? Bless you. It's okay if you pay a little bit more for it when you rent it, because those are costs you can always take out of the system later, right? You know what it could be if you bought the truck instead of leased it. So that's not an assumption you need to prove. That's easy. Whether you can get the customers, that's harder. Whether you need that big a truck for the kind of jobs you get, like that you don't know until you try. So always early on, trade off large fixed investments, trade those away for, rentals or fractional type things that you can do until you're sure that you actually need that equipment or that investment.
Yeah. And it's always worth it. It's always worth it to rent something at a higher price than to have that something permanently on your balance sheet and you're having to pay that monthly payment, whether you have work or not. So
yeah, it does. Down the road, once you've proven that you need it and you need it consistently, you buy it, you finance it. So okay, now you have you've got your lease payments. Sorry, not your lease payments. You got your mortgage payments, whatever it is, your loan payments as opposed to your rental, and they'll be lower. But remember, you can get out of a lease quickly,
Yeah. So tell me about some of your what are some really cool projects that you've been part of?
Oh, okay. So let's fast forward a little bit, right? So, so here I am. I've been working at Dream Adventures for 2 years, gone through, I think, 24, 25 startups in that time. And our CEO comes to us and says, we're doing okay. We're top 5. I don't want to be top 5. I want to be number 1. How can we be number 1? So if you think about it, there's a couple of companies that are, further ahead of us and much better capitalized than us, right? So, I don't think we can do it, right? Even if we do everything right and some of them do a few things wrong, we're not going to get to number 1, number 2, maybe number 3. So he said, yeah, okay. That's what I thought. I don't want to be number 1, number 2. I don't want to be number 1. I don't want to be number 2 and number 3. So find us an area where we can be number 1. And that took the thinking along and put it on its side. So, we had traditionally been working on those companies that were 2/3 or 3/4 baked, helping them get to that point and raising their first round of financing. There were a whole bunch of other startups that were one step further along. They'd raised a little money, they already had revenue, and they would try to get to what we would call Series A, the next round of financing. And there was really nobody playing in that space. Now, what we did for the earlier stage companies doesn't apply for them, right? These founders already figured out a lot of that. So we had to do different things, but there was some overlap. Like the customer introductions were, in fact, the single biggest draw. That's why people were coming to us, even though they were too late, saying, hey, we really love that you get these great customer introductions. I'm beyond the stage of what you do, and I can't take the deal that you did because I'm worth more than that. But is there any way we can work together? And until then, we're like, we just can't. That's not what we do. But then when the CEO had kind of challenged us to think differently, like, well, hey, we do have this whole untapped demand for a different type of program. And surprisingly, the large corporations that we were connecting these startups with, I'd say probably 3/4 of the time, they would say, oh, Jen, those are really, really interesting startups. That's a really painful problem that they're solving. Very creative solution, stellar team, but they're just a little too early to work with a Fortune 500 company. So we're going to watch them for another 6 to 12 months. But hey, keep bringing us those cutting edge ideas. And like morons, we kept bringing it to them. They kept saying 6 to 12 months. So then when we're thinking, wait, hold on, we have these later stage startups. And these corporates, even though they say cutting edge, what they really mean is cutting edge plus a year, like a little bit of revenue. We have supply, we have demand. We can make that market. Now we have to change everything that we do and how we charge for everything that we do. But we have an opportunity to be number 1 in a space no one else is in. And that happens a lot. It happens a lot in all sorts of businesses where you may go into the market thinking you're going to do X, and then you realize, well, no one's doing X. No one's doing Y. I keep getting asked for Y. This is kind of cool. Maybe I'll do that instead. And you have to, have your eyes open to it. One of the big mistakes founders make is well, that's not what I do. I'm in this box. That's kind of cool. And they kind of forget about it. When you open the aperture for a bit, and I say, well, why don't I do that? Why don't I do that instead? I do that in addition, but sometimes why don't I do that instead? You can find yourself in a totally new field where you're not fighting for airtime, you're not fighting for customers in a crowded room, and everything just becomes easier.
Mm-hmm. So how quickly were you able to kind of pivot into that new space?
We had the new program. We took about 2 months just to talk to a lot of startups. It took us like a couple of weeks of talking amongst ourselves what we thought it would be. That was our thesis, right? Mm-hmm. Well-reasoned, but loosely held. And we talked to a bunch of different startups to make sure like the services we thought that made sense for them did make sense for them, that the structure and how we would deliver it would make sense. Like for one thing, in the older model, people would come, physically relocate, be in the city, and kind of live out of that office for 3 months. The 2 founders, the 3 founders, they're from Austin, they come to New York, and like they're in the program. Mm-hmm. For a later stage startup where they might have 10 or 20 or more people already on payroll, like that doesn't fly. So it was 3/4 or almost 3/4 remote even before COVID, because that's what we needed to do for that market. So we tested that. Would you come for 2 weeks here and 2 weeks here in person, as long as the rest was remote? And we tested like, okay, we have a different offer, right? I mean, just giving you a little bit of cash and taking 7-8% of your company doesn't fly for you. We get it, but would you do this instead? So that took about 2 months of like talking to a lot of different people, thinking about the answers, making corrections in how we did it. And that was just a question of execution, right? I mean, everything we do is kind of virtual. A lot of it's up here. So, we had to think about how we communicated. We had to think about how our infrastructure changed a little bit to make that work. We were very lean. We were lean because we didn't have that much money. So it wasn't that hard to switch. Remember, rent the truck, don't buy it at first. So I'd say from the moment we had that offsite to when we ran our first program, including recruiting the startups for the program, was less than a year. Okay.
But these were all startups that were already kind of in your ecosystem, it sounds like, or at least ones you were aware of, or no? No? Okay.
Remember, like this is a moving target, right?
Gotcha. Okay.
Every 18 months or so, you move up or you go out of business.
You're okay.
Right?
Your timeline's shifting.
Yeah. And the other thing that we learned along the way was if we're going to do a program that's very focused around customer introductions, then it's far more efficient to be vertically focused, to be in one industry than it is to have 12 companies in 12 different industries. Mm-hmm. So I ended up spinning up an ed tech program, for companies that serviced K-12 schools or universities or corporate learning departments. There's a backstory why we did that, but it was a very different market, a very different customer base. So we had to go out there and build it. Like there was a lot of times where I would just kind of, I totally agree with you. And then I'd run home and I'd Google the acronyms I'd never heard of before. So there wasn't as much overlap on the connection side as you might imagine. Mm-hmm. But that's the beauty of being in an untapped space. Like if no one else is doing it, it's very easy to get someone's attention. So it's not like that. Actually, let me turn that around, right? So one of the biggest challenges we had, and it's happened to me a couple of times in my career, is how do you get across to someone that what you're doing is actually different than they already have. So back when we were doing Bunk One, we would go out, go to these conferences, we'd stand in front of the booth, always stand in front of the booth, never behind the booth, because you got to snag people. And we'd say, hey, Jen, do you have a website for your camp? Because we figured like this is 2000, like that would get people in. They'd be like, yeah, I got a website. And they just kept walking. Their website was a 3-page brochure. I mean, it wasn't at all what we were talking about. I was like, damn, like there's no hook there. They just keep walking. So then we stumbled upon the hook. It's like, oh, but do you have a password protected photo gallery? So remember in 2000, a lot of people were starting to take pictures on like digital cameras. Mm-hmm. So they were kind of used to that. And they kind of had the expectation. I've sent my child off to summer camp. I want to see photos of him playing. And the directors are like, I don't know how to do that. Like I'm on dial-up. Mm-hmm. I don't know how to do it. And I'm really worried that like some pervert's going to look at photos at the lake and do, I don't know, bad things. And I need to lock them out. So they knew as a director that they had parents like pushing them, I want to see photos. And at the same side, they didn't know how to do it. So the moment we said, but do you have a password protected photo gallery? They stopped walking and came back to the booth. Mm-hmm. So you got to have that one quick phrase. It doesn't have to be everything you do. We did a lot of other things, but you have to have that one hook, the tweet length hook, that gets someone to come back and says, oh yeah, Jen, you are doing something different than what I've seen before. Instead of me going down the aisle and trying to find a peanut butter substitute, because that's what I need, I just realized I need this more. I'm going to stop.
Okay.
And then when we went to Dream It, when we switched to a later stage program, we learned, if we said the A word, accelerator, startups stopped listening. I'm beyond that stage. I've already gone that. I did one already, right? Or no, I got past that. Not for me. So we actually had to change. We had to purge the word accelerator from our vocabulary. We had to call it, hey, we are the only program, I think we just call it program or scale-up program. We're the only scale-up program for startups that are beyond the accelerator stage. And then all of a sudden, wait, what does that mean? But that's okay. That bought us a minute to actually tell them what it was. Mm-hmm. So whatever you're doing, it's not enough to be exciting and different. You need to have that concise 8-second, 120 character hook that makes it immediately and obviously different to your customers. Until you have that, you're banging your head against the wall. Once you have it, the doors are wide open.
Okay. That's interesting because, so really all you're saying is, not all you're saying, but you have to disrupt their thinking too, because in situations where it's people don't want to be sold to constantly, right? So it's do you have a website? Yeah, they might even be a lie, right? They don't have a website at all, but they just don't want to talk to anybody.
Exactly. So let's put our empathy hats on, which we talked about earlier, right? Mm-hmm. Now it's different when you're selling a social media thing and it's just fun. It's time filling. Yeah. But most of the startups we're talking about and small businesses we're talking about should be time saving, where you're selling to people who are time starved. So I'm putting my camp director hat on. I'm at this conference. I've come from Wichita. You thought I was going to say Kansas City, whatever. I've come from Wichita to Chicago. I'm here for 2 days. I need to get new pool toys for the lake or lake toys, pool toys, whatever it is. I want to see what they've got. These allergy things are killing me. I got to go find a sunflower butter that doesn't suck, right? Oh, I got to go see a bunch of my buddies I haven't seen for a while. And I got to go stop by the staffing table because every year I'm struggling to find tennis instructors. I got all this going on. And then I just passed this other booth and someone's like, hey, do you have a website? And he's like, by the way, I already got one. It's kind of shorthand in their mind for F you, I'm busy, right? Mm-hmm. So you got to put yourself in that mindset. If that's your customer, and you literally, that's not true. You figuratively have to shock them out of that, right? It has to be that compelling.
Yes, so do not literally shock them.
Yeah, I did look at a startup at one point that was creating pads that would generate electricity as people walked over them. But usually, you want the energy to go from the person into the pad, not the other way around. Yeah, that would be interesting. That would be a lawsuit, actually, probably.
Yeah. Okay. Well, so as we kind of wrap up here, this is a very broad question, but what advice to those people in that startup phase can you give? I know you've told them what characteristics they need to develop, but what's that one thing that you're everybody needs to know this in order to be successful here?
Do you know why I'm smiling?
Why?
Because the one piece of advice is to buy the book.
Exactly.
This is 20 years of advice all in one place. Look at the cool cover, right? There's a guy, he's hacking his way through the maze, right? There's a lot of puns.
Somebody wanted to buy your book. Where do they find it?
Oh, where do you buy everything in life? On Amazon, right?
Of course. I was gonna say.
It's on Amazon. It's called The Entrepreneur's Odyssey. I'm pretty sure there's no other book by that title. There's certainly no other book by that title that I've written. And it's certainly not with that cool cover. By the way, don't buy the hardcover. The hardcover is designed for libraries, and my publisher charges $190 for it.
Oh, goodness.
Unbelievable. I'm like, you can't do this. And it's yeah, we have to. It's for libraries. I'm like, then don't put it on Amazon. They're like, no, we can't. And I've talked to other people, Routledge has been very supportive, but that's the one thing they don't push on. So look for the one with the cool cover. It's the paperback or the Kindle version. Buy it, read it. I hope it'll save you a lot of time and money. And it may mean the difference between a startup that fails because you ran out of money or time by making one or two kind of suboptimal decisions and actually having that startup succeed.
If somebody wants to find you or work with you, do you work with people? What do you do now?
Yeah, so there's a couple of choices, right? So, if you're like, hell with that, I'm tired of hearing this guy speak, just buy the book, that's fine, we're cool. If you're kind of curious, you want a little bit more, my website is andrewackerman.com. If you're very curious, you can find me on LinkedIn. I do 6 or 7 things right now. I invest primarily in startups in the real estate and construction space. I also do a lot of work with large corporates around structuring innovation programs, everything from a corporate venture fund to a venture studio to accelerators. If you're interested about that, find me. I'd love to talk to you about that. And.
Awesome. Well, thank you, Andrew. I merged your 2 names there. Thank you, Andrew, for being on the show today. It's been a pleasure talking with you and very interesting. I feel like I learned a lot of things today. So I appreciate you being here.
Thank you for having me.